Hi there, traders. This is Matt Krupski here at Chartered Financial Services with your weekly options report coming to you today on Tuesday, August the 15th. This week we've got crude oil options expiring. September crude oil options expire on Thursday the 17th. Again, just as a reminder, we take a look at open interest in the options due to hedging activity. As we approach expiration, hedging activity increases. If there's a large open interest at a particular strike, it can drive the underlying market. So here, looking at the graph of open interest in September, we can see the red line there. We closed yesterday right around 47.50. This morning trading a little bit lower. Interesting to note here between really the 46 line and the 48 line, if you look at the 45 line and the 50 line, you can see two big spikes on the graph. That represents the large open interest in the 45 puts and $50 calls respectively. But in between there, it's kind of a lull. So generally, a lot of times what happens when we see not a big open interest, kind of a no man's land here, that wallow in this area. Looking at the percentage of options that could finish in the money, if we finish between 47 and 47.5, that puts about 89% of the calls out of the money and 75% of the puts out of the money. Go up half a strike between 47.5 and 48, that puts 88% of the calls out of the money, so only 1% more of the calls go in the money there. And the puts drop to 22% in the money or 78% out of the money. So looking at possible settlement prices and percentage of calls and puts that are in the money, generally we tend to go towards driving the fewest percentage of calls and fewest percentage of puts in the money. To satisfy that requirement would put us in the between 47 and 49, which kind of equates to what we see on the graph as well. Again, always there's a chance if there's a big spike on a graph, we start to drift towards that spike, it can act like a magnet and pull us towards that number. This morning we're drifting down a little bit. We've kind of been trending down over the last couple days. You do see a spike at the 46 line and the 45 line. That's due to those 22,000 puts in the 46 line and 28,000 in the 45 line. If something happens that we do continue lower and those puts start to look like they could come into play in the money, you could see some momentum build off of that as people who are short those options have to sell futures as the deltas increase to kind of hedge their portfolios. So that could drive us down to the 45 line. I don't think that's going to happen in this case. I do think it's going to be kind of a uneventful expiration. Looking at inventories, of course, we have inventory tomorrow. Inventories have been steadily decreasing, drawing down the record builds we've had built up over the last year or year and a half. We've seen inventory start to come out, which should support prices and keep us kind of in this 47 to 49 range. As always, these are just my thoughts, not those of ADM Investor Services, or Chartered Financial Services. If you'd like to talk about how this hedging works and why a lot of times the underlying futures are driven by the open interest, I'd love to talk to you. You can hit me up on Twitter, shoot me an email, give me a buzz. I'd love to hear from you. Thanks. Have a great day.